Welcome to our ongoing series of podcasts of interviews with HVAC and plumbing industry leaders and contractors like yourselves. My name's Mike Layton, and I am the founder of an HVAC and plumbing consulting company called Stochastic Marketing that is currently tracking more than $8 billion of our customers' residential HVAC and plumbing sales. So in a book that I co-authored titled 8-Figure Exit Strategy for HVAC and Plumbing Contractors, which is a mouthful, I talked about a contractor's need to engage a variety of experts when considering an exit strategy. Here with me today is one of those experts, Brandon Jacobs. Say hello, Brandon.
Hey, Mike. How you doing?
Not bad. So, in addition to being a Texas Aggie and an author, Brandon has spent more than 25 years working on contractor valuations and acquisitions all over the country. And I've worked with Brandon for about 10 years. And after plying him with some drinks and dinner, he agreed to share some of his insights into some of the questions that contractors should have answers for, whether they're buying or selling a business. Brandon, for those guys who haven't read your books or don't know you, can you give our listeners an idea of how many contractors' financials you've examined over the years?
Oh, Mike, it's a tough estimate, but it's well over 2,000.
So
and
2,000 is more than a first date, right?
It's a wide range of contractors as well.
And the size ranges, right? So, I mean, little guys under $1 million and $50 million plus, big guys too, right?
Absolutely. There's really no end to it. In fact, Mike, this week, it's funny that you asked that. This week I was working with a $1.2 million a year contractor, and then on the next phone call working with a $15 million a year contractor. So it does range.
Hey, Brandon, I think some contractors only see a business valuation as something they need to do when they're actively buying or selling a business. Most of our listeners aren't in that situation right now. Why is this podcast important to all listeners today?
Mike, no doubt, having what you just said, having a solid understanding of the value of your business when you're actively planning to sell it or actively planning to buy a business, having the understanding of that value is critical. But you're right. Some people listening today might not be intending to sell or buy a business for many years. However, they should listen, because I like to think in this podcast today, we're going to cover off on some of those things that drive value. Hopefully we could give them a basic understanding of what drives value. And this is going to be important to any contractor, whether they're planning to sell their business 2 years from now or 10 years from now.
Well, why don't we just, for our listeners, let's start with the basics. You've talked about, what's fair market value. We hear that term a lot, fair market value or FMV.
Mm-hmm.
What does it mean?
Okay. Well, let me jump into that. It's actually defined by our friends at the IRS, and it was defined many years ago. And I'm going to paraphrase it because you know how those guys like to define things. But it's basically the price at which a willing seller and a willing buyer, with neither of those two acting in compulsion or acting without the relevant facts, will buy a piece of property. And that piece of property could be, in this case, a business or anything else.
Okay, so both parties are willing, and they're not acting under compulsion, and are aware of the facts. Aware being a tricky term, right? Can a business sell for more or less than full market value?
Absolutely. And the best example would be in a situation where, let's say I'm a business owner and I fail to prepare and the need to sell my business happens today. I want to retire. Maybe, God forbid, there's a health scare. I'm now acting in a compulsion. I have to do something immediately. In that case, unfortunately, somebody's business certainly might sell for less than fair market value. Can they sell for more than fair market value? Absolutely. Another example, going back to being aware of the facts. I'm a buyer. Let's say I'm just coming into the industry. I'm not familiar with all the risk factors associated with a contracting business. In that situation, a buyer might step in and incorrectly pay more than fair market value for that business.
Okay, so what about, the old saying, and we're all business owners here, so we kind of hope that this is the case, but when guys say my business is worth more than what someone is willing to pay for that, is that true?
Or another way to say that is, and maybe this is what you're saying is, I hear people say that, right? My business is only worth what somebody's willing to pay for. It's kind of a cop-out, right? That typically is the business owner that's not ready to know the reality, and it's not the most accurate statement, right? Because certainly a non-willing buyer or would-be buyer could offer me a price for my business, and that certainly could be, again, less than fair market value, and that's certainly not the value of my business. Now, if 10 people offered me that same price for my business, then there is something to that, and that's a little bit of a different situation.
Right. So what's a typical process? What's it take to generate the typical valuation? What does it take into consideration? When you're doing these 2,000 valuations, when you've looked at all these books, what are you looking at? What do you take into consideration when you're coming up with at least a fair market value kind of number?
Okay. There are several things that are taken into consideration. Most importantly is the current historical financial statements, but we also look at the customers, the contractor's work mix, the employees, the tenure of his employees, how strong is his employee base. Of course, we look at management. Can somebody step in and operate that business subsequent to the sale of the business? And then we look at operating history. The market that the company operates in comes into consideration. And then, of course, the current balance sheet is something that's taken into significant consideration as well.
And when, like most small businesses, and no business is small if it's yours, but a lot of people do use a lot of different accounting methods when they're keeping track of their business. So are there different methods you have to use to value a business so that people get more comfortable with the valuation?
Absolutely. There's actually three generally accepted approaches to business valuations, and I'd be glad to share those with you. They're the market approach, the asset approach, and then the earnings approach.
Okay, so what's the difference? Can you kind of explain them to the layman?
Absolutely. Let's start with the market approach. The best way to the market approach is I'll kind of explain it in a real estate term. All right, if you lived on a street and three houses on your street that were relatively close to what your house looks like, and the timing was relatively close, if these three houses each sold for $200,000, then it's relatively safe to assume that the fair market value for your house is also $200,000. So in this case, it does take in the historical transactions, recent historical transactions, and they have to be comparable. We're talking businesses now, right? We can't say this $20 million contracting business sold for this amount of money, so my $2 million contracting business would also sell for this kind of money as well. The challenge in privately held business valuations with the market approach is that typically there is not enough data, right? In any one town, how many air conditioning or plumbing businesses are sold in a typical year? It's just not going. There's just not going to be enough relative current data to support a consistent conclusion.
Okay, well, what about the asset approach? At least contractors are all driving vans and they all have tools and, they have comparable assets if they're all HVAC contractors or plumbing contractors. What about an asset approach?
Yeah, the asset approach is used when a business has historically lost money or broken even. And it basically says the goodwill value of that business is zero. And the only thing of value are the assets. It's almost saying I could sell my assets. I get nothing for the going concern. I get nothing for actually having a business. It's the value of the assets. It's definitely not what any contractor wants to have used to value his business when it comes time for the big sale.
Okay. How about goodwill? You talked about goodwill. Is that just like a throwaway, or what's that mean? I mean, what's goodwill mean?
Goodwill means the value that's assigned to the assets of a business that can't be touched or felt, right? I mean, we could touch a vehicle, we could touch computers, we could touch furniture and tools, but we can't touch this business's ability to continue to make profits, its reputation, its company name, its expertise, et cetera, et cetera, et cetera. All these things are considered goodwill, and all these things to a business that's capable of showing earnings has value.
So sort of the goodwill value that for a business that has some earnings is kind of like its brand value. Is that another way to look at it?
Absolutely. And again, once a business is able to demonstrate earnings, we start looking at the earnings approach to value that business.
Okay. Well, what's the most important value driver? I mean, what really counts?
Before I jump into that, Mike, let me go back and just the earnings approach. Kind of go a little deeper into the earnings approach. The earnings approach is used to assign value to that goodwill, right? We could value the hard assets, but it's that intangible assets. Again, the assets that we can't touch or feel that hopefully will have a significant value to a business owner.
So is that like the sales team's performance, their culture, their training, their brand, the things that a guy with 8 good techs is going to be very different than a guy with 8 guys that don't know what they're doing and don't produce? Is that kind of what the goodwill's really kind of doing? Okay.
Yeah, absolutely. Because typically in that example, the company with the good technicians, it's going to be profitable. The company with the untrained technicians, the companies who haven't invested in marketing, they're not going to make as much money, and therefore their goodwill is going to be less.
So when you're having the 3 different valuation methods, hopefully they kind of reinforce each other. A business with good earnings is probably going to have more goodwill. A person with
no doubt
assets, right? So if they have some assets, okay, they're going to have the assets there, but the earnings potential justifies the goodwill, and that reinforces the earnings. And is the assets just like a kind of reality check on how much iron's there and the building and everything else?
Absolutely. And you did ask earlier, what is the most important value driver? And I'd be glad to answer that. Without a doubt, the most important value driver to a business is that business's ability to demonstrate positive and consistent earnings. It's not about the trucks. It's not about anything other than, can I demonstrate, that's the single most important thing, consistent positive earnings.
Okay, so when you're going through that valuation process, contractors, they might be a little intimidated about the accounting and all the records you need for evaluation. Is this like an IRS audit that's nothing but painful, or is it really easier than that?
Well, you know, a valuation expert could make a valuation project as tough or as easy as they want. But if the valuation expert has experience in analyzing and valuing contracting businesses, it's not going to be nearly as brutal as, say, an IRS audit. Not even close.
Or for instance, you know, to your point, HVAC and plumbing contractors are sort of a unique animal. So if you go to some crackerjack accountant and he's valuing restaurants and taverns and construction companies, and then you're the second HVAC contractor he's looked at, it probably is a little painful as opposed to coming to somebody like yourself that says, I've looked at these for 10 years, 20 years. I know if the numbers make sense or if they look like something's missing.
No doubt, and not only that, you have to step back and say, does this accountant who has only reviewed or studied 2 plumbing and air conditioning businesses, does he know the ins and outs of the industry? Because let's face it, our industry has some differences that should be taken into consideration.
Well, how long a period do you have to dig into? I mean, what's the time period that's valid, right? You don't have to go back 20 years. How many years of performance do you really need?
No, 20 years is definitely ancient history. Some valuation people look at 5 years. However, in my practical experience of buying and selling air conditioning businesses, right, because I've been on both sides, both as a buyer and both as a seller, typically 3 years is as far back as anybody's going to really take a hard look at.
So, like, if I'm somebody who's thinking about trying to sell my business, or if I'm looking at buying a business, it's 2 sides of the same coin. The fact that I might have had a bad year 5 years ago, maybe even 4 years ago, for plenty of understandable reasons, staff changes, whatever it could be. What you're really saying is that's really not going to hurt your fair market value if you're trying to sell it. Is that right?
That's correct. Definitely, I have had people call me and say, I'm waiting, I'm recovering. I had a bad year. To your example, I had a bad year 5 years ago. I want to wait till that gets further behind me, and there's really no need for that.
So it's really just 3 years that count, right?
Definitely 3 years.
So, but even if I had a rough year 3 years ago, that's not a reason to at least establish where you are now, right?
That's correct. And let me share how someone would look at that, or how I would look at that, is when I'm doing a business valuation, I do request the most recent 3 years. And I look at that run in several different ways. I like to look at a 3-year average. What's my average earnings over those 3-year periods? Then I like to look at the 3-year weighted average. Okay, it gives a higher emphasis on the most recent year. And then I also just like to look alone. What have they done in the last 12 months? Because in some cases, a buyer might focus strictly on that last 12 months. I then take those ranges all into consideration, and my valuations return a range, a high range and a low range, and it's all contingent upon those different earning periods. Let me interrupt you. Yeah. However, I do want to emphasize that anybody is listening and is considering selling their business, that most recent year, the last 12 months, is the most important period.
Because that's the staff the buyer's potentially buying, right? I mean, not 3 years ago. Staff turns over all the time. So the recent, if your most recent year is really strong, that's what everybody's going to focus on, right?
They're going to focus on it. The best bet would be to have 3 going out to a buyer. The best would have 3 good, strong years and to show some growth in those 3 years. But again, you wouldn't, if you had to do something today, waiting because 3 years ago it wasn't the best year, it is maybe not the best choice.
Well, multiples are a number that's often kicked around because it's real easy in your mind to go, is it 3, is it 4, is it 5, is it 6, whatever it is. They talk about it all the time. And I understand sellers, you want a high multiple. Buyers are trying to rationalize the low multiple. But, okay, multiples of what?
When we hear the word multiple, and I think some people do get confused hearing that, it's a multiple of earnings. Go back to the earnings stream I talked about a minute ago. What's my business capable of doing in earnings in a year? Well, we would apply a multiple of those earnings. Simple example, let's say my business was capable of producing $1 million a year in earnings. We might apply a multiple to that $1 million of earnings to come up with the enterprise value. Now, to your point, it has to be said that the multiple is a factor of the estimated risk associated with that business. And we do hear in our industry and other industries a very narrow range of multiples tossed around. 4 or 5. They pay 4 or 5. Buyers buy 4 or 5. That is not necessarily the case because certainly some businesses do not deserve they could deserve a 3. Some businesses might pop over that 5 mark and earn a higher multiple than 5. However, it's important for all listeners to know it depends on the risk factors of their specific company.
Well, it kind of sounds kind of subjective. I mean, is it that subjective?
It certainly is. Again, kind of to reiterate what I just said, it's impossible to wave a magic wand and say all businesses trade at a 4 multiple. And somebody's going to step in and they're going to take a look at the individual risk factors of that business that's being purchased or valued. A smaller, privately held contracting business is certainly a riskier business, and therefore it certainly deserves to have a lower multiple. When we start looking at larger contracting businesses, obviously they're going to have management in place. They're going to have procedures in place. They're going to have a business that's more likely not going to stumble upon a sale. And therefore, an investor might be willing to pay a higher multiple and therefore a higher purchase price for that business. Take publicly traded stocks. They trade on multiples as well. They trade on significantly higher multiples than what someone would ever dream of in the private sector, because they are less risky.
Well, I know in the book that I wrote with Walter Bergeron, I talked about guys needing to get their business, whether that's a mix of HVAC and plumbing or HVAC plumbing and electrical or HVAC and pest control, whatever it is, try and get that aggregate total sales over 10 million, because then the buyers view that as less risky than a guy that's at 2. But I think there's so much more we can talk about for our listeners because it's such an important topic. Instead of recording this for an hour, maybe what we ought to do is just kind of take a break here.
Okay.
And then maybe just kind of pick up this conversation so it's in more bite-sized chunks. I know we've been talking for 20 minutes or so. But if we can just maybe get on the phone again in a couple days and kind of pick it up, because multiples are easy to understand for somebody. I'd rather have, if I'm selling, I'd rather get 6 than 3. If I'm buying, I'd rather have pay 3 than 6. But if we can just pick this conversation up in a next day or so, I know you got to run out to an appointment. We can kind of dig into this in more detail. If in the meantime, though, if a contractor's kind of listened to this or downloaded the white paper, you can either go to and get copies of Brandon's 2 books, which was a lot of work, you can either get it at stochasticmkt.com, or you can reach Brandon at his website. It's contractorscfo.com. That's easy enough, contractorscfo.com. Or just click on the link that's along with this. And I would also like to encourage some of our listeners to check out meerconference.com, MEER conference.com. Every year we host a unique 2-day conference where we dig into everyone's numbers. Typically we'll have 100 contractors in a room with Stochastic and industry experts like Brandon, just digging into how to grow businesses and make them more valuable. And the best part of it, it's free. So all you have to do to get yourself to that conference is just get yourself there. I'll pay for everything else, and you can talk to Brandon in person. But again, you can just check that out at meerconference.com. And if you kind of watch your email for sort of round 2, because all of us as business owners, figuring out our exit strategy and what our business is worth is, in theory, kind of what drives everything we're trying to do for the most part. But I appreciate everybody listening to this, and I really appreciate Brandon. I mean, I know I'm catching you on the road while you're trying to get to another appointment, but if we can just get together the next couple days, kind of pick it up again.
Absolutely, Mike.
All right.
I love talking about it, and I definitely would like to spread the word and help out as many contractors as we can.
Yeah, because this, for all of us generally, I mean, not for you, but for people like myself, and I do help people value like the market, how much business they can do from the marketing side of things. But if you're thinking about buying or selling a business, for some guys, it's the only time in your life you're going to do it, and you got to talk to an expert, particularly an expert that actually understands your business, and that's why I appreciate you agreeing to make some time available in between some of your appointments. But
no problem.
Always good talking to you,